Hi guys, welcome to my channel. So before we get started, make sure to hit that like button, also subscribe to my channel. How to invest in a financial crisis. So make sure to watch the full video. The financial crisis of 2008 and the Great Recession that followed is still fresh in the memories of many investors. People saw their portfolios lose 30% or more of their values, and older workers saw their 401 plans and IRAs drop to levels threatening their retirement plans. Instead of acting rationally during severe bear markets, many people tend to overreact and make matters worse. However, while many people panicked or were forced to sell assets at low prices, a small group of patient, methodical investors saw the stock market collapse as an opportunity. Investing in a crisis is no doubt risky, for the timeline and scope of recovery is uncertain at best. Double-dip recessions are a real possibility, and attempting to pick a bottom is largely a matter of luck. Still, those investors who are able to invest in a crisis without succumbing to irrational fear and anxiety may reap outsized returns during a recovery. How crises affect investors. Investors generally do not behave as predicted by traditional financial theory, in which each individual behaves rationally to maximize utility. Rather, people often behave irrationally and let emotions get in the way, especially when the economy is experiencing some chaos. The emerging field of behavioral finance attempts to describe how people actually behave versus how financial theory predicts they should. Behavioral finance shows that people, rather than being merely risk-averse, are actually more loss-averse. This means that people feel the emotional pain of a loss much more than the pleasure gained from an equal-sized profit. Not only that, but loss aversion describes people's tendency to sell winners too early and to hold on to losses for too long. When people are in the black, they act risk-averse, yet when they're in the red, they become risk-seeking. Take, for example, a blackjack player at a casino. When winning, he may start playing more conservatively and betting smaller amounts to preserve his winnings. If that same player is down money, however, he may take on much more risk by doubling down or increasing bets on riskier hands in order to break even. Investors behave similarly. Unfortunately, taking on excess risk when experiencing losses tends to only compound the magnitude of those losses. These emotional biases may persist even after a recovery has begun. In a survey by online broker Capital One ShareBuilder, 93% of millennials indicated that they distrust the markets and are less confident about investing as a result. Even with historically low interest rates, more than 40% of this generation's wealth is in the form of cash. Due to the crisis, young Americans are not gaining the stock and bond market exposure that has helped older generations accumulate wealth. Taking advantage of a crisis. While most investors are panicking as asset prices plummet, those with a cool head are able to see the resulting low prices as a buying opportunity. Buying assets from those restless individuals, driven by fear, is like buying them on sale. Often, fear drives asset prices well below their fundamental or intrinsic values, rewarding patient investors who allow prices to revert to their expected levels. Profiting from investing in a crisis requires discipline, patience, and, of course, enough wealth in liquid assets to make opportunistic purchases. When calamity strikes, markets fear the worst, and stocks are punished accordingly. But historically, when the dust clears, optimism returns and prices bounce back to where they were, with markets responding once more to fundamental signals rather than to perceived turmoil. A study by Ned Davis Research Group looked at 28 global crises over the past 100 years, from the German invasion of France in World War II to terrorist attacks such as that on 9/11. Each time, markets overreacted and fell too far only to recover shortly thereafter. Those investors who sold on the fear found themselves having to buy back their portfolios at higher prices, while patient investors were rewarded. Stock markets aren't the only way to invest in a crisis. The Great Recession also saw a collapse in home prices as the housing market bubble burst. People who could no longer afford their mortgages foreclosed and many homes were underwater, the mortgage amount owed to the bank exceeding the equity value of the property. Home buyers and those investing in real estate were able to pick up valuable real assets at below normal prices, and as a result, have been able to enjoy handsome returns as the housing market has stabilized and recovered. Similarly, so-called vulture investors have also been able to profit from taking over good companies that have been battered by a recession but have otherwise good fundamentals. Betting on a crisis to happen. Another way to make money on a crisis is to bet that one will happen. Short selling stocks or short equity index futures is one way to profit from a bear market. A short seller borrows shares that they don't already own in order to sell them and hopefully buy them back at a lower price. Another way to monetize a down market is to use option strategies, such as buying puts which gain in value as the market falls, or by selling call options which will expire to a price of zero if they expire out of the money. Similar strategies can be employed in bond and commodity markets. For those individuals seeking simply to protect themselves from a crisis and not necessarily bet on such an event occurring, owning a well-diversified portfolio, including positions in asset classes with low correlations, can help cushion the blow. Those with access to derivatives markets can also employ hedging strategies, such as a protective put or covered call, to lessen the severity of potential losses. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go.